Inflation and deflation are not mutually exclusive. However, it's short-term inflation I'm talking about, along the lines with long-term deflation. And I'll prove it right here. You ready? So we're going to start, my friends, with my man Christian over at Ice Age Farmer, iceagefarmer.com. And I'm a big fan of Christian. He's a very well-thought-out, well-researched guy. I don't agree with all of the stuff he says. Imagine that. Imagine many of you don't agree with all the stuff I say, I hope. But he gets me thinking. And I like people get me thinking. It makes me happy to think, what am I missing potentially? We should subscribe to his YouTube channel at Ice Age Farmer. Brace for impacts about to get much worse. We're staring down the barrel of a confluence of several scenarios, each of which individually is a significant life-changing event, but which are together conspiring is a dangerous and incendiary situation. Food shortages, inflation, and breakdown of supply chain. Okay, I got to throw breakdown the supply chain and food shortages together, but either way. A new media narrative now acknowledges food shortages, but blames animal agriculture. All right, so let's read what my man Christian has to say here, because like I said, I'm a big fan of Christian. And we're going to start with this right here. Let me just get this link. He didn't link it. I didn't link. I cut and paste it there. Blink. All right, so let's go over here. We're going to go up here. Krakow. All right. So this is going to be from AmericanShipper.com. All right. And brace for impact. Data shows U.S. import demand still rising. All right. So as a Deutsche Bank analyst says, you ain't seen nothing yet about American shipping back in March. And he was right. The latest data reveals that despite a deluge of inbound cargo since the second half of last year, import demand is not abating. It's actually increasing. Importers are still playing catch-up. The Institute of Supply Management released Monday dropped a 28.4 for April, which is the new lowest record ever since 1997, and is down from 34% from pre-COVID. As one retail survey respondent said, market capacity in most areas is oversold with no realistic improvement on the future and on the horizon. Market capacity, hang tight. It appears that demand will continue to strengthen, leading to more significant disruptions. All right, that's pretty interesting to me. However, let's keep going. Let's see. The numbers show imports surging past 2020 levels in the first 3 months of the year. In the first quarter of last year, imports were depressed because of COVID. All right, interesting. The next 3 months should see strong gains on the year, given that 2020 imports in May, June, and early July were depressed by U.S. lockdowns and as carriers blanked or canceled sailings. Given that imports in May, June, and July were depressed by U.S. lockdowns as carriers canceled sailings. The question ahead is whether 2021's of imports will keep pace with gains seen last September and December. The growing consensus is that they will. In fact, the custom shipments may undercount growth. All right, let's keep going though. With ships, right here, could port volumes increase further to meet the increasing demand? With ships and containers equipment effectively maxed out. With ships and container equipment capacity effectively maxed out. The question for U.S. ports is whether record high import volumes have any room to increase. The tiny bit of good news for shippers is that the capacity should slowly come back to the market in June because the congestion situation is getting slightly better. As of Tuesday, there are 19 container ships at anchor off Los Angeles Long Beach, down from an average of about 30 earlier this year. All right, that might be welcome news for shippers looking for slots, but not so welcome for U.S. ports hoping for a breather so terminals can be cleared out before the traditional July to October peak season. Does anything right there say anything's odd there? All right, so let's keep reading this because there is something that's odd. Well, it's not really odd. It makes sense though. Trans-Pacific is deteriorating. Brace for shipping tsunami. And this is back in April 26. The number, let's see, what I'm seeing is unprecedented. We're seeing a tsunami of freight, says one guy. For the month of May, everything on the Trans-Pacific is basically sold out. We had one client who needed something loaded in May that was extremely urgent and was ready to pay $15,000 per container. I couldn't get it loaded. We are a growing company that ships lots of TEUs, which is 20-foot equivalent units, price doesn't always even matter anymore. Ah, boy. All right, so with imports far outpacing retail sales growth. Interesting. He attributed volumes to inventory restocking. The restocking is actually affecting the trade even more than the growth in demand. That tells me that this will last even longer. Let's say U.S. consumer demand slows down in Q3 and Q4. Capacity and rate shouldn't improve quickly simply because of huge restocking demand. All right? As a result of the backlog and restocking demand, he thinks prices will remain high and shipping will probably remain difficult for the rest of this year. And after that, you'll have the peak for the Chinese New Year in 2020. All right, so that's the inflationary component. Supply chain disruptions, all right? Inflation, no other way around that. Why do we have a supply chain disruption? Because everything was shut down. All right, so here we got a product. All right, so here's the product. And here's the consumer. All right, this is called just-in-time inventory, the product and consumer. So the consumer wants it and they'll start building it. The problem is everything on the product side is also affected by lockdowns and supply chain, from the actual employee who's got to put together the product to the mining of the goods to get the minerals, to the developing of the plastic, to the steels, all this stuff. Just every single thing goes into supply chains. One thing breaks down, everything else follows suit. It's a conveyor belt, man. We're living in a conveyor belt society where one thing, and you can even add to that, if you have insane unemployment rates, people aren't wanting to work, there is going to be a lag in orders being fulfilled. But now you have even a higher demand because people say, oh, I better get this now because it's going to cost more in the future, so I'm going to go ahead and buy it now. That's the short-term inflation stuff that we have. And it's not rocket science here, my friends. Now, the best thing about capitalism, as long as government doesn't get their greedy noses too involved, there will be entrepreneurs who fill the gap. No capitalist ever says there's market efficiencies. They always say there's market inefficiencies is capitalist. Profit-seeking individuals say, I think I can make money here, and I'm going to go in and fill the void, and that's what's going to happen here for sure, as long as Sniffy Joe and the rest of the people stay out. All right, but now let's talk about that's the short-term stuff. That will go away as the supply chains and markets work. The magic of the markets. Let's talk about the real pandemic, though, the real stuff we got to deal with that. All right, this is the velocity of M2 money stock, and this is from the St. Louis Fed. Economic data since 1991, but this data goes back to 1959. So for every dollar in the U.S. economy, it changes hands by 1959 1.7 times. All right, and the height of 1997 was about 2.174 was the velocity of money. So every dollar doubled the amount of transactions, even more so in the economy. And of course, the economy back then was booming. What has happened since? Well, even pre-COVID, it was down more than half, about 60% in velocity to 1.441. So for every dollar created, it was the lowest it had ever been. That's Q3 of 2019. Q4 2019 less. And then we go into here, of course, COVID, it fell to freaking 1.1, but it's still at 1.123. That's with the stimulus checks and everything. So the lowest it's ever been was even right in here, 2013, hell, going back to 2011. The monetary supply has fallen, the velocity has fallen off a cliff, man. There's no two ways around that. Now let's look at the Japanese money. Oh, look at that, same thing. Not the monetary supply, the velocity of money. So let me just revisit that. The velocity of money, not not the money stock, because the money stock is huge. I don't know if they show it here. Recent decrease in velocity. Let's see what that one is. I haven't looked at this yet. So that's 2016. The recent decrease in the velocity of money. All right. So anyway, and you can see even this. I mean, look at that. It's just freaking nuts, man. All right. So anyway, let's keep going. I want to show you the Japanese. This is the Japanese velocity of money. We go back to 1990, say 2. The velocity of money is way down here. What does that coincide with? Well, let's see what these guys say. Accounting for the decline of the velocity of money in the Japanese economy. And this is from a deputy director for Institute for Monetary and Economic Studies, the Bank of Japan, the BOJ. So he writes in 2011, what accounts for it? A notable feature of the Japanese economy following the banking crisis of the late 1990s is the drastic decline in the velocity of the money and the consequent decline in the price level. Based on the inventory model of money demand by a couple people, we explore how macroeconomic shocks affect the velocity. Households in the model are subject to a multiple period cash in advance constraint in which the portion of payment of cash, which we call the liquidity requirement, varies according to the credit, service, supply, and the economy. So basically what this guy is saying, I don't know why I just can't say this, how much are households requiring that they keep in cash? Now you might think like bank reserves, that the Fed requires on the banks to get the reserve system. They're not saying that. They're saying you have your own reserves in your own mind, your own economic, emotional state. How much money do I need to keep in cash to deal with whatever the future holds, if that makes sense? So you have your own reserve requirements. We're not talking the reserve requirements from a federal government or you're a banker. You're just you, little Josh and Charlotte. How much cash are we keeping on the side? That's our reserve requirements, what they call liquidity requirements. Extracting various shocks underlying the velocity variations from 1990 to 2010, we find that an increase in the liquidity requirement, the cash on hand, is a key driver in the decline of the velocity of money. Particularly important is the channel stemming from households' expectations about the future liquidity requirement. During the Japanese banking crisis and the global financial crisis, credit services disrupted and households expect the disruption to last long. Since they demand additional money for a higher liquidity requirement for current and future transactions, the velocity and price level decrease, even though the growth rate of the money stock exceeds that of consumption. Let's see if we can't find the money stock. Hold on just a second. Japan's monetary base grew by 20.8% year over year in March 2001. So the money stock has grown, I'm not going to say exponentially, but look at that, man. Look, it's just growing like crazy. The money supply is growing like nuts. The money supply, the money stock that's out there. Crazy. Japan M1 year over year. Look at that percentage. It's nuts. Nuts. And yet the velocity of money is not doing that at all. Isn't that crazy? Another chart, Japan money stock, money supply. M2 money in Japan increased to whatever that is. But just look at that. Look at that increase. And yet, if we took velocity of money, it'd be the exact opposite. It's nuts. Look at that, man. All right, hang tight. An interesting piece here too. This is that no? One double. I wonder if I can make it log. I guess not. But anyway, so here's a money supply, and look at that massive amounts of increase in money out there. Look at that. And here's when the velocity started slowing down right here. This is the United States, by the way. Look at that. The velocity of money started slowing down right here. And here, that's the top. It's gone down ever since. And yet the monetary supply has gone up. I was reading another article, and I'm not sure I'm going to be able to find it, but it says how the money supply increase is actually deflationary. Let me see if I can't find it. That's a pretty good article. Josh Brown, and I don't follow this guy that much, but he writes some good stuff every now and again. I just doesn't do me right. But anyway, I like this. He says this guy he cites goes on to make the point that QE is deflationary because it sinks net interest margins for banks by depressing treasury bond yields. It also enriches the already wealthy via asset price inflation, but they do not raise their consumption in response because how much more crap can they possibly buy? Finally, it leads to a preference for share buybacks versus investment spending because the payback from financial engineering is so much easier and immediate. I tell you, man. And here's the monetary supply, the velocity across Europe, Japan, and the U.S. as well, just dropping like a freaking brick in water, man. I 100%. Why were the inflation hawks so wrong about quantitative easing? And they're going to be so wrong about this because, again, the absent velocity of money could be looked at as either ineffective or actually causing a deflationary environment for sure, as my man over here, where was it? Right here. The velocity of money and price level decrease even though the growth rate of money exceeds the rate of consumption, and they're going to have a decline. And the decline in the velocity of money, a consequent decline in the price level. Now, why is that? Well, because people get nervous. They see people in the United States, as people did in Japan, they went through two horrible bear markets in the aughts, and they're saying never again. Remember, you can't go bankrupt if you got no debt. And so they're like, I'm never doing that again. I am never going to be without. Remember, I did. I relied on my home equity line of credit and a 0% credit card, rate credit card as my emergency fund. The bank took USA, they took away your home equity line of credit. And as such, the interest rates went up because I was maxed out then. I wasn't maxed out before. If I had $80,000 line, I only had $30,000 on it. And now they dropped it to $30,000. I'm 100% loan to value, which means my interest rates go up. My credit card was 0% for the life of the loan, and then all of a sudden went to 14.49. I said, I called them up, said, what the hell? I said, yeah, look at the fine print. In times of trouble. I said, well, this is nuts. I had no liquidity. I said, never happen again. And same thing with businesses. Pablo! Me and you and many business owners say, I am never going to be naked like that again, which is exactly what happened in Japan. I don't have the books in right here. When Richard Koo talks about the balance sheet recession, they're saying, we don't care if you can lower interest rates to zero. We don't care. We don't want the debt on the books. We don't want to be liable the next time the market cycled down. And not just the stock market, I'm talking the economy as a whole. We want to be free of that. And as much as Dave Ramsey can drive me crazy, he's much better as a positive than negative in the overall case of society, because telling people to free yourself from the shackles of debt. Get out of debt and keep cash on the side. I could not agree more. And as such, a balance sheet recession is inherently deflationary. The Feds can lower the rates. The banks can give you teaser loans. People say, I'm not going through that again. I've been through it twice in my life. In the last 20 years, it's not happening again. I'll keep the cash on the side. Thanks, sir. Now, how they account for that? Well, they start penalizing you for keeping cash, which is going to happen. I mean, they're going to go into an e-dollar currency and probably make Bitcoin illegal and all that. But we're not there now. But when they do, Argentina-like, Venezuela-like, where you had to trade in your previous Venezuela dollars for the Bolivar and whatnot, or Bolivar, the same thing's gonna happen here. But wait, we'll cross that bridge at that point. Right now, though, it's not inflationary; it's deflationary. All right, we'll see you. Love to hear your comments.